Momentum indicators. Before we go on to discuss the individual momentum indicators, I'd like to spend a few minutes discussing what exactly a momentum indicator is, and how is it different to a trend indicator. Now let's recap what a trend indicator is. A trend indicator is used to determine the overall trend of the price. Is the price going up? Is it going down? What is the current trend? And when do trends start and when do they end? And how do we take advantage of them? Momentum looks at something a little different. Whereas trend indicators are primarily focused on the direction, momentum indicators are focused on the magnitude of price movements. By magnitude, what we mean is that it's looking at by how much is the price changing. Is it changing by a lot? Is it changing by a little bit? And is that increasing or decreasing? So for example, we would be looking at whether the price is moving up very, very quickly, whether it's moving very slowly, or whether it's moving down quickly or slowly, and what does this mean for its future direction. So one of the main things we use it for is to determine whether a trend is weakening. If we do see that a trend is in place, we may find that the momentum of the price is slowing down. It's not moving up or down as quickly as it once was. And this could indicate a weakening of a trend. And a weakening of a trend could in turn indicate that a reversal is due to take place. Now, one of the other common things we use momentum indicators for is to determine whether a security is overbought or oversold. An overbought security means that the price has gone up so much to the point where it's been bought too much and therefore it will come down. So that's actually a reversal indicator. Likewise with oversold, an oversold asset means that its price has fallen so much that it's been sold off too much that it will turn around and rise again. And that would again be a reversal indicator. So you can see how it's fundamentally and conceptually different from trend indicators. Now, if you remember in the previous lecture, we talked about the fact that trend indicators tend to work when markets are trending. They do not tend to work so well when markets are not trending. Momentum indicators, most of the time, are in the opposite camp. Momentum indicators tend to work best when markets are not trending. So if markets are not in a trend, or they're not in a strong trend, right? They can be in a weak trend and momentum indicators will generally work fine. However, if markets are in a strong trend, one way or the other, then the momentum indicators will not work as well, right? These overbought and oversold indicators will give us false information or false signals whenever markets are in a strong trend. So momentum indicators are what we want to use when markets are not trending or not trending very much. And quite often what we will see is that momentum indicators may give us conflicting signals to trend indicators. So a trend indicator may tell us to buy the asset, whereas a momentum indicator might tell us to sell the asset. And this is a common thing that occurs when we have indicators that work in different scenarios. Because trend indicators are assuming the trends will continue, whereas momentum indicators are often looking at situations where assets are overbought or oversold and a reversal will take place. And when we talk about trading systems in the next module, we'll get down to learning about which are the right indicators to use in what situations. But for now, let's just keep in mind that we should be using momentum indicators whenever markets are not in a strong trend or not trending at all. Rate of change. The first momentum indicator we'll talk about is called the rate of change. Now, we've probably all heard the term before, rate of change, and in this situation it's no different to what you would expect it would mean. The rate of change indicator measures the percentage change in price movements over time for a specified time period. Usually it'll be n days, right? So it could be 10 days or 5 days or 20 days. So the rate of change is looking at the percentage changes in price over a particular number of days. So for example, I could say that over the last 10 days the price has changed by X%, right? And then every day this would be updated, right? Because we'd look at the price today and the price 10 days ago and look at the percentage change. The formula for rate of change is equal to the price today minus the price n days ago. So that p t minus n means the price 10 days ago or n days ago. The price today minus the price n days ago divided by the price n days ago times 100%, and that's just to convert it into a percentage form. So that's what rate of change means. Now, how do we actually interpret rate of change? Well, if the rate of change is very high, that indicates that the security is overbought. Okay? And if we have a rate of change that's quite high, when it starts to turn around and fall, this indicates a sell signal. Alright, so if we see the rate of change quite high, then when it turns around, that is a sell signal. In contrast, when the rate of change is very low, this indicates a security that is oversold. And when that rate of change starts to turn around, this would be a buy signal. Okay? So this rate of change is a reversal indicator, right? It's looking at the momentum of the price and looking at the change in the momentum that will indicate a reversal in the trend of the price. Most of the time, the price and the rate of change will move together. So if the price is going up, rate of change tends to rise. If the price is going down, rate of change tends to fall. Whenever we have a divergence in the price and the rate of change, this is a sign of a weak trend, and this is a sign that it will likely stop or reverse. So we could actually use rate of change in a number of ways in order for us to develop a trading strategy. There are many trading strategies we can use. So one is this overbought, oversold situation where we look at when the rate of change starts to turn. Okay? So now what we'll do is we'll look at rate of change on the web. We'll look at this in Yahoo Finance because it is available on there. And then after that, we'll look at it in Excel as well, just like we have been doing in the previous lectures. Rate of change. Now here we are in Yahoo Finance, and once again I have the same chart up that we had previously. This might be a day later, but it's more or less the same chart. So it's from July 2011 to July 2012 of the Nifty index, and what we are going to do is plot the rate of change indicator and see exactly what it looks like, and from that we'll try and figure out a trading strategy with it as well. Alright, so the rate of change indicator can be found in the technical indicators menu. So if you follow my cursor here, I'm going into technical indicators, and if I go down, you'll see this ROC, which is rate of change. So I'll click on that, and now it asks me for the default period. Okay, and this is looking at the number of days. If you remember, we said the rate of change is over a period of days, so we could have a 10-day rate of change, a 15-day, a 20-day. In this case, they've set the default rate of change to 12 days, and we'll just go with this 12-day rate of change. Now I'm going to click Draw Now, and then you see over here the rate of change. Alright, and this now is telling us the rate of change and what we can do with it. So what we need to do now is look at when the rate of change turns around, and then what does that mean? So in this case, for example, I have the rate of change down here, alright, and this, when this price turns around, that would be a buy signal. Okay, now just to clarify these numbers here, this is actually in percent, but it's actually times 100. So this, for example, 123 means actually 12.3%. So this can go from minus 100 to 100%. Alright, so this is just an extra digit here to make it easier to interpret. And whenever we see the rate of change very high, that indicates a reversal is due to take place. So for example, at these points here, I may decide to take a short position, and eventually the price would end up coming down, and then we would see it going down here. At this point here, right when the price turns back up, I would want to take a long position. So then we would see the price go up here. And again here, the rate of change is falling again, so I would take a short position. So this would work fairly well. At this point here, the rate of change rises again, and I would want a long position, and then it goes up again from here. So you can see that the rate of change indicator gives us some decent signals. There are cases, for example, over here. In this case now the rate of change is high and there's a slight fall, but then the price actually keeps going up. So you can see that in this case, when the market's trending upwards, it does not work as well. It works better when the market is oscillating up and down. Let's now go ahead and take a look at the rate of change in Excel. We'll actually calculate it and then see what we can do with that. Rate of change. Here we are back in Excel, and this is the same data set that we had for the previous lectures. It's the value of the Nifty index from 2005 until 2011. And what we are going to do is calculate the rate of change in this graph, just like we've been doing for the other indicators in previous lectures. We'll follow the same strategy here, and we'll calculate the rate of change based on this Nifty index, just like we saw it in the graph on Yahoo Finance. So let me go into the ROC tab, rate of change tab, and again here I just have the same data set. So to calculate the rate of change, I'll calculate it for a 12-day period, which is what we drew on the chart earlier. And it's a fairly simple calculation. It's going to be this value here minus the price 12 days ago, which will be row 13, divided by the price 12 days ago. Copy this all the way down. I want this in percentage terms with the decimal place, and here we can see the rate of change. I'll just delete the ones at the bottom because these do not have enough values to calculate, so I'll just get rid of those. Alright, and now here I have the rate of change, right? So over a 12-day period, this is my rate of change, and you can see that sometimes it's positive and sometimes it's negative. So now we can devise different trading rules. So we can say, for example, if when the rate of change starts increasing and is low, then we should have a long position. When the rate of change starts decreasing and is high, then we should have a short position. So I'll just try one strategy out just to show you what it would look like. We won't go through all the calculations, but I'll show you how to come up with the positions at least. So let's say I want to create a strategy whereby when the rate of change, okay, is, let's say, below 7%, alright, or let's say below 5%, then I want a long position. So let's say when it's below minus 5%, I want a long position, and when it's above plus 5%, I want a short position, because that indicates to me that it's either oversold or overbought. So I could, for example, create a position whereby I could say, well, if this value, let's do that again. If this value here is greater than 5%, then I'll have a short position, otherwise no position, and this will give me my short positions. And then I can have another column for my long positions, which would say, similar to this, I'll copy this across and back to C2. If it is less than minus 5%, then I would like a long position. Now I copy this down, and I copy this down, and now you can see I have a number of instances where I would have a long position or short position. Whenever there's a -1, that would be a short. Whenever there's a 1, there's a long. Smoothed rate of change. Now we looked at the rate of change indicator in the Excel slide, so we saw how to calculate the rate of change and a potential trading rule from that. Now there are multiple trading rules we can do, so that's not necessarily the same one we did in the chart, but because that one's more complex, I didn't really want to go through it because it would take a lot of time. But you know, we'll talk about trading rules more later on. But just to give you an idea of how the indicator is calculated and what you can do with it, the next indicator we'll talk about is the smoothed rate of change. This is similar to the rate of change. The only difference is that we use an exponential moving average instead of the price. So when we're calculating the rate of change, instead of calculating the rate of change of the price, we'll calculate the rate of change of the exponential moving average. So really, the only difference in the formula is that we're going to replace price with exponential moving average. Thus, the smooth rate of change measures the percentage change in the EMA over time for a specified time period, or n days. Right? So SROC equals EMAT minus EMAT minus n divided by EMAT minus n times 100%. Now, how do we interpret the rate of change? Well, again, it's very similar to the rate of change. So whatever trading strategy or interpretation we have for the smooth rate of change will be fairly similar for the rate of change, and it's used to identify oversold and overbought conditions. And the reason we use the smooth rate of change is that this uses an EMA rather than the actual price. So we're calculating the rate of change on something that is trying to determine the trend. Right? So we're looking at a change in the trend, and if we feel that the EMA does a better job of telling us the trend than the actual price itself, because, for example, it is smoother and doesn't have that many distortions, then the smooth rate of change can provide an advantage over the normal rate of change. Now, as we said, trading strategies can be modified for these two indicators. So there's no real fixed trading strategy to use the rate of change. So we just gave a couple of different examples earlier. And really, you can kind of devise different rules with them. So, for example, you can say when it changes, or when it's above or below a certain value, or when it's high or low for a particular amount of time, then the rate of change will tell us to either do a buy or a sell signal. So there's really no fixed rule when it comes to the rate of change, which is not the case for other indicators. A lot of other indicators have fixed rules, but these are ones which can be modified and changed to suit our needs. So when we do trading systems, we'll incorporate these into our trading rules and see what the best way is to use it. Smooth rate of change. Now here we are back in Excel, and what we are now going to do is calculate the smooth rate of change. So we'll go to the next tab, and the smooth rate of change, as we discussed, is based on an exponential moving average. The first thing we need to thus do is calculate the exponential moving average. So I'll calculate the 20-day exponential moving average. So I'll do EMA 20. Now, hopefully we remember how to calculate the exponential moving average from doing it multiple times in the past two lectures, but we'll just review it again. The exponential moving average is going to be equal to the price on the day minus the EMA, and again, for the first day we just have to use the price itself. Alright, times 2 divided by the number of days, in this case will be 20 plus 1. Alright, plus the prior day EMA. And now I have the value for the 20-day EMA. I'll copy this all the way up. And now I have my EMA 20-day exponential moving average. Now let's calculate the smooth rate of change. So I'll calculate the SROC, and we'll do 12 days. And this is going to be really similar to the calculation we did earlier. The only difference will be that we'll be using the EMA to calculate the rate of change. So the smooth rate of change will be equal to the EMA on this day minus the EMA 12 days ago divided by the EMA 12 days ago. Take this all the way down, and then I'll convert this into a percent, add a decimal place, and now you can see the smooth rate of change. And of course we have these last 10 values which we need to get rid of. So now what you can see with the smooth rate of change is that it's actually smoother than the actual rate of change. So let me go to this older tab which has rate of change on it. You'll see that these numbers tend to vary a lot. So you see a 10% here, you see over 6% here, you see large numbers here both going up and down. Again, see some minus 10s over there. So you see a lot more up and down movement in this rate of change. When I go to the smooth rate of change, we'll see that these numbers are a lot smaller, right? So I've got 2.9%, 3%, 4%. It doesn't really get up to the 6%, and certainly doesn't get up to 10% like we did with the rate of change. And this makes a lot of sense, right? Because the exponential moving average does not shift in the same way as the actual index, right? The actual index is more volatile than its own moving average, right? The EMA is always going to be less volatile than the underlying index, and as a result, the rate of change will be smoother and less volatile. The smooth rate of change will be smoother, which makes sense from the name, will be smoother than the normal rate of change. So again, we can develop a similar trading strategy with this. In the previous one, we said if it was below -5%, that's a buy, above 5%, that's a sell. And we could maybe change it. We maybe wouldn't want to use 5% in this case because the smooth rate of change doesn't really hit 5% very often. So we may have a different threshold, and we may also have when the rate of change goes from positive to negative, that then we would want to initiate a position, or when it changes sign, or when it changes in magnitude up to a certain level. So as we said, there are a variety of different ways we can calculate this rate of change. Now remember, when we do the smooth rate of change, we have to take into account two different variables. So we need the EMA for the certain number of days. So in this case, we've used the 20-day exponential moving average, and then the 12-day smooth rate of change. But we can of course use different values. We could use the 5-day EMA, and we could use the 10-day smooth rate of change. It doesn't necessarily need to be the case that one day is greater than the other one. So the EMA doesn't have to be of a higher day than the smooth rate of change days. They can be reversed as well. They can be of the same length of days. So there's really endless possibilities when it comes to looking at this rate of change. Now, just generally, this rate of change is kind of a very simple momentum indicator because it's really just looking at percentage changes in price. Now, as we go on into the lecture, we'll look at some more complex ones, ones that are used more commonly. So rate of changes tends to be used less commonly than others. So the next one we'll talk about is the relative strength index, which is a fairly much more used and much more common indicator, but also a bit more complex. So let's go ahead and discuss that now.